Hey guys, welcome to the podcast. I am doing this from my second day on the road as a young family, so excuse me for being on a balcony of a hotel room, but I hope you can hear and see correctly for what will be a presentation today. So I want to run through a series of things I see going on at the moment that I, as an investor, am keeping a very close eye on. And hopefully by the end of this video, you'll have a good introduction to a few different areas of importance. Basically, what's the smart money doing right now? And what can we think about protecting our wealth on what will be, an extraordinarily interesting, let's say 3 to 6 month period ahead where we get an all-time high. But then what happens after that? How do you retain the purchasing power that Bitcoin will surge to without just running it all the way back down to the bottom of the next bear market? So I'm going to bring up a couple of bits of content. As always, reach out for any questions, etc. when you get, come across stuff you don't like, and do reach out. So I'm going to share my screen. So first of all, we're going to go here, a recent episode of What Bitcoin Did with Dr. Jeff Ross and Danny Knowles. Shout out to those guys.
Okay, let's do this chart. So this is the S&P priced in gold.
S&P 500 price in gold. It's a 100-year chart. Goes back to, I think this chart is back to about 1924. I cannot stop thinking about this chart. And, I'm a hedge fund manager. We had a great year last year. It was the, and not to flex, but it was the top performing multi-strategy hedge fund in the world last year.
Let's go, Jeff.
According to Barclay Hedge database, we returned 199% after fees.
Damn.
So I only say that not to flex, but to just give credence. Like I'm a pretty good investor.
I'll flex for you, Jeff. You know what's going on. That's fucking incredible.
I'm not a terrible investor. And so I only say that just for you guys to take a little bit of credence into what I'm saying and to actually consider this.
Can I just quickly explain this for anyone who's listening on audio and can't see the chart? So this is the S&P priced in gold. We have 4 highs, which is September 1929, just before the Great Depression, October 1967, which is just before everything got super inflationary. Is that right?
Yep.
Then 99 dot-com boom, and then you also have Jan 22 in here.
Yep.
Okay, so run us through it.
Okay, so the way I explain it initially to people is, if you were given the choice, if you understand financial history, and most people who are in Bitcoin or in the investment world do, if I asked you if it was the year 1929 or 1969 or 1999, and you could invest in either US stocks for the next 10 years or gold for the next 10 years, what would you do?
Easy answer.
Easy answer, right? Everybody would say that. And so I think, based on this chart, but not just based on the chart, I think when you look at everything that's happening in the whole geopolitical sphere, this is clearly what's happening. There are 10 to 20 year segments or even longer where the world.
So that's enough of that for now. If you're interested in that specific conversation, do go and look it up. It's absolutely awesome. As you hear, Jeff he's not fucking around. His hedge fund did 199% last year. That's an incredible return. So it's not just someone with deep expertise, but also it's the results to back it up. And what's he looking at? And this is what I love as an investor. I go and learn about what people who have clearly created themselves a strategy that works. Success leaves clues is a phrase that I love. What are they looking at? And so my analysis on this chart is quite straightforward. It's like, holy shit, not just the boom and bust of the last 100 years, it's very obvious, but where's the actual value growth? And that is why money printing is so nefarious. Everyone thinks they're getting rich because the dollar figure is going up. But the reality is purchasing power is barely changing. So the difference between the bull market top of 1929 and 2022 are very, very similar. If you look at the chart, what's the difference? It's barely moved. And that's because this is the S&P index being priced in gold. And it happens all the time. Go and follow what the local housing market you live in priced in gold. It won't have changed all that much. Indeed, the amount that it costs for a fine tailored suit from Savile Row today is roughly the same amount as what a nice item of clothing for a gentleman of the Roman era would pay in gold. The point is, value can be seen differently when measured differently. And that's what Bitcoin does. It starts to measure things differently, as does gold. And so, awesome moment for me really was that idea of, okay, well, hang on. What does it mean if the denominator of all the stuff I'm looking at is actually disintegrating in value? and the assets themselves aren't getting more and more and more expensive, the money is being debased, and therefore you can buy less stuff with it. And this is a 100-year time frame, and clearly shows that the S&P, you can buy as much of it today with gold as you could in 1929. What the hell? So very, very insightful. Point here is he's looking at cycles, and he's trying to think about, okay, what's going to happen over the next 10 years? Where is liquidity going to come from? How's that going to change things? Go and listen to the whole conversation. I absolutely loved it. That tees me up nicely, though, and shout out to my friend Jigs. He creates this, and he's got a group here. You can join it, go and find it, where he is able to basically use technical analysis to figure out what is the optimal strategy for buying and selling Bitcoin. And it basically is a multi-year strategy of buying at the bottom of the bear and selling at the top of the bull. The question is, when is that? And so you can have a very good understanding of what you want to buy, but you then have to answer, when are you going to buy it? And so Jigs runs through an analysis here. I highly recommend you reach out to him. He's very generous with his time, and also the information that he prepares for the people that are part of his community. I'm actually a paying member, lifetime member, and I get these semi-regular updates. But he's looking at the amount of blocks that are being mined and when roughly the all-time high is versus previous historical all-time highs and block height. Very, very interesting. He's talking about 25-week windows. Very, very interesting. And equally then goes on to use AI to make a prediction as to when that block height will actually run. Now, because of the difficulty adjustment, each block is completed at about 10 minutes each time, but it's not always. It can be more than 10 minutes, less than 10 minutes. So it's very difficult to say exactly when the block height will be reached. But his latest target is around about the middle of October. Okay, interesting. So, okay, Dr. Jeff's talking about long-term cycles, boom busts, liquidity increases of the dollar, what might happen next. He's looking at the S&P index priced in gold. And now I'm talking about Jigs, who's thinking through, okay, well, when is the all-time high going to actually be achieved based on historic data that we can use to project forwards? Okay, so we're thinking about maybe the all-time high will be October this year. That's slightly later than the original August date that I had in mind, but certainly something to keep in mind of. It's like you might want to take some profits off the table when it comes to Bitcoin, just because of the fact you've been in this asset for 2 to 3 years, position potentially, and why not? And I love this. It's like, okay, cool. Now I have a data-driven approach. When should I be thinking about selling if I was going to take some profits off the table? Well, now I'm going to push it back from August to more like a kind of end September, October date. Next, Mark Moss. Shout out to Mark. He ran through some great stuff in this video, but in particular, not just hammering the fact that altcoins are dead. There's a chart about Ethereum's all-time high versus Bitcoin, and it's just years ago and keeps getting worse and worse and worse. But also, it's about what's the smart money doing now. Let me just give you a little clip of it.
We're throwing hundreds of thousands of dollars in, and these coins were taking off, very small market caps. But in phase 2, we go from what's called the retail eruption phase to what's called the frenzy phase. Now, the frenzy phase is represented by institutional and sovereign demand. So instead of individuals throwing in thousands or tens of thousands or hundreds of thousands of dollars, we now have institutions that are coming in with billions of dollars, tens of billions of dollars. And so the market completely changes. Now, we can see this pretty simply if we look at some other charts of data. So for example, what is more profitable, crypto or Bitcoin? So in 2025, buying Bitcoin is more likely profitable. However, from 2017 to 2019, investing in crypto was more profitable. It was. The answers change. So it was more profitable than investing in Bitcoin on average. Okay? But today, this is no longer the case. According to data gathered by eToro, talk to them, approximately 90% of crypto traders lose money. That's because crypto traders are playing in phase 1 strategy while we're currently in phase 2. I'm going to show you this, and I'm going to show you what the strategy is moving forward. Now, we can see this again on another chart here, which kind of illustrates it. So what we have here in the gold line is Bitcoin, and the black line is cryptocurrency. And you can see how Bitcoin has completely distanced itself. And the reason why, again, is because cryptocurrency has thousands and tens of thousands and hundreds of thousands of dollars going into it. And over here, we have hundreds of billions going into it. And so it's just a completely different market.
So Mark always packs his videos with great insights. It's data driven. And what I took out of this is like, the institutions are waking up in a way that might not be automatically that obvious. And he makes the case at the start. He's part of the Bitcoin Opportunity Fund. I know he's also obviously creating content in the space. He's an investor in a number of different businesses, advises to startups, absolutely seeing a huge amount of actual business activity. This is not someone that's sitting on YouTube and watching videos. He's actually seeing stuff come through his email, come through his phone calls, come through the face-to-face meetings he has, and he can see the market shifting and making a very, very clear case for anyone sitting around with assets in altcoins. Bitcoin is absolutely turbocharging away from them, and that's not going to change because the size of capital that's about to inflow into Bitcoin through the Bitcoin treasury companies, through the issuance of bonds, through just nation states finally catching up to this thing, it's going to completely melt faces. And it's a fascinating video because, like, okay, well, as a retail investor, I'm trying to get information from different places that helps me make decisions. And it's now very clear to me that A, you back the right horse, Bitcoin, which is great. B, don't buy any altcoins. But C, it's then like, what next? So, okay, we're going to see a period of a very inflationary period. How do you navigate that time? What assets do you use? Going back to Dr. Jeff, he's very, very bullish on Bitcoin, but also very bullish on gold and equally emerging market equities and European equities. Okay, well, so maybe there are some companies that you could be allocating into, but altcoins, like, absolutely forget it. I will not be going near those things in a million years. Putting aside the kind of ethical stance I have on the fact that people are basically, well, I won't go into the altcoin scam topic right now, but the point here is, okay, there's big money coming into Bitcoin. What do you do about it? Now, this is where I have been thinking about, like, okay, if October is going to be a time where you might take some profits, and you have to answer then the question, what do I do with them? If you're not owning Bitcoin, what do you want to buy? Now, I think Dr. Jeff's shout for some gold is a great shout, but how else might you position yourself? Like, if Bitcoin does draw down from 150, 180,000 US dollars, maybe even higher, well, it could easily get back to roughly where we are today, the 100K range, if not high 80s, 90s. I don't know. But I want to position myself for an instance where that might happen, but continue to drive my purchasing power up. Now, this is very much the realm of what professional investors do on behalf of their clients to retain purchasing power over time. The key, of course, is to be using metrics that actually tell you the truth. And hence that chart pricing the S&P in gold is so insightful because it's like, oh my God, no one who's owned S&P stocks across the last 100 years have actually made any money. What? Right? Everyone thinks they're getting rich, but they're not. So I just want to take you now to an article that's been very impactful for me recently. So shout out to the Wizard of Oz. And I'm very keen on this idea of unlocking Bitcoin equity through leverage. But I have yet to do it. And I don't know what it is that stopped me, but I just haven't seen a product that's really made sense. And I've also not understood, like, what am I going to do with the capital once I've taken that loan? And in particular, I've been trying to understand how to buy a house. That's the only thing I would really want to buy. So, okay, I need a mortgage of some form. I can use the property as collateral for that. But then you've got to get the deposit from somewhere. If you sell your Bitcoin, then you don't have any Bitcoin cap growth. Could you do it with a loan? Oh, but then you get shitty terms. It's like you've got to put $1 million worth of Bitcoin in to get 500 grand out. Does that make sense in terms of the 50% loan to value ratios? The liquidity risk is high. The counterparty risk is high. And then this came through and I'm like, wow, the tax risk is also really high. And so again, I'm not going to read the whole article. Please dig it up. I'll put links to all this stuff in the show notes. But the really important point here is, and what Wiz points out, you have to be very, very careful as to what happens with the custody of the Bitcoin that you take leverage against. He made some recommendations of some businesses to check out. So Firefish, I had Igor on the podcast recently. Check out the episode with him. And I have a friend who is actively using Debify and is really, really happy with them. So I was going to just show you that website as well. But what I thought there was a couple of bullet points I was looking for. Okay, here we go. So the thing that really hit me here is basically, right, let's give the example of Australia. The Australian Tax Office has a very specific way of looking at ownership of assets when it comes to whether or not there has been a capital disposal or not. And what Wiz points out is that if you use a centralized lender, then there is a case to be made that when you send your Bitcoin to this other party, that actually creates a change of beneficial ownership of those assets, which means it's actually a capital disposal. And then on top of that, if the person you've sent your Bitcoin to get the loan from is mixing your capital in with other pool of Bitcoin being used as collateral, that again hammers home that it's been a change of ownership. Now, it's legal jargon, it's small print, but it's like, phew. Imagine if you'd gone and said, okay, I'm going to take a loan of 50% of my Bitcoin stack, so I'll get a 25% leverage against my entire wealth. And actually now that the ATO is going to be calling you up saying, by the way, that 50% of Bitcoin you sent to get leverage against, well, you owe us CGT on that. Like, shit. So not only are you paying for the cost of the loan, you're also paying for the cost of the tax to send it to someone as if you've sold it. Like, whoa, this is a massive, massive road bump that people have not thought about a lot. Well, what does it mean? It's very simple in a sense. If you send your Bitcoin into a non-custodial service, then the ownership of those coins has not strictly changed hands, and therefore there is not necessarily a taxable event. Now, this is a massive point. Okay, so now I could, using some of the products that are out there, as I mentioned already, Firefish, Debify. I'm just going to bring up here, this is the Debify website, go check it out. I had a small play around with it myself, logged in. You get your own seed phrase in case you lose your key as the backup, and there's then basically a marketplace. So on the one side of the marketplace, you have people with Bitcoin that are willing to lend it to get collateral, to use it as collateral for a loan. And on the other side, you've got people with dollar capital, like stable coins, that they want to then loan out to people for a fixed return. Now, the interesting part here, and just to hammer home this tax point, is if you use a non-custodial Bitcoin leverage platform, then there is no CGT to pay. Interesting. Okay, so now you've got to find a non-custodial service. Obviously, you then have to find someone within that marketplace that actually wants to loan you their money in exchange for putting your Bitcoin into an escrow, essentially. Now, Igor will talk me through how Firefish works. They use things called oracles. And it's kind of like having a multi-sig account where the lender has a key, the borrower has a key, and then the third party in the middle, i.e. Firefish or Debify, they have control of what is essentially a smart contract where if the borrower doesn't pay on time, or if the collateral doesn't cover the loan at an effective rate, they can step in to kind of mediate. What I mean by that is the liquidity risk. So if Bitcoin's 100K today and it drops to 50 grand, then your loan to value ratio is no longer 50%, you're at 100% if you'd taken a 50K loan out, at which point you need to put more Bitcoin in there. The point with that, though, that's interesting is actually you can manage that. And especially someone like my friend Jigs, again, shout out to him, who's got excellent technical skills. He can look at the price of Bitcoin and he can start to predict when he's going to have liquidity problems and make sure he's got Bitcoin sitting on the sidelines to then put into whatever loan contracts he's got set up. Now, shout out to my friend Jeremy, who sent me this week, zone21.com, really interesting comparison site that's popped up. So, okay, look, well, we can see here, they even have detailed the custody of it, right? So that Unchained, Debify, I don't know who these people are down here. Firefish, there we go. LenderSat's another business I've heard about. DeFi. So these guys, that's non-custodial to my understanding. Now, each of them have different credit limits, 50% LTV, 70% LTV. So you can work through this and try and find terms that make sense for what you're looking for. But, you know, people who are taking loans from Strike, for example, they are, in my opinion, in breach of the CGT terms of the Australian Tax Office. Now, in my experience, having grown up in the UK and now lived in Australia, the UK will have very similar rules as well. This, to me, is a big problem because people haven't understood this. You know, Leaden, for example, which is where actually Wiz originally came across this issue, they're happy to share with you their terms, but they make it very, very clear that they are not tax advisors and that all of the tax risk is on your shoulders. And rest assured, they will come and find you if they think they owe you lots of money. Now, the really important piece here that has to fit into the market or has to fit into your strategy is, okay, let's just say we're going to have an all-time high later this year. Okay, that's going to be the maximum purchasing power that I can drive out of this current investment strategy. Should I take some profits off the table? 10%, 20%, 30%, 50%? I don't know. My daughter's waving at me through the window. And you have to decide that for yourself. Maybe even 100%. You're so confident on this idea of cycles remaining. Go for it. But what do you do with the capital? Do you keep it in a stable coin somewhere on a exchange or in self-custody? Do you keep it in physical dollars in a bank account somewhere? I don't know. You've got to take into account counterparty risk, got to take into account inflation risk, all sorts of things to think about. But shout out to my friend Costa, who came on the podcast earlier this year. And this is really the kind of magic sauce that's just starting to kind of fall into place for me in a way that I hadn't understood before. And so this is his business miner tool, and it is a trading tool. One of the things I'm trying to do as a podcaster is like, how can I make money out of my podcast? And something I'm really trying to lean into is this intuitive sense of, well, see what comes to you. Like, who comes onto your podcast that's interesting? What are they working on that you resonate with? And Costa was just someone that was really building something that I was like, that's kind of cool. I've got to learn more. And to learn more, well, you've got to dive on in there. Okay, I'll be a customer. Let me sign up. Let me send you the money. Let me figure it out. And as part of my onboarding, they were talking about, okay, well, the most efficient way of doing this is actually taking collateral, taking your Bitcoin as collateral, taking the dollar figure against that of stable coins, and then trading those stable coins against the Bitcoin position with their bot. And you're like, okay, but hang on, what about the CGT exposure of that? And initially I was signed up with Bybit to take a loan against. I'm like, well, that's a centralized platform. I can't do that. And then I thought through it. So, well, hang on a second. What if I use a non-custodial lending partner, like a Debify, like a Firefish? I send my Bitcoin to them, and I take leverage against them in USDT. That USDT can then go to someone like Bybit, but also Deribit as well. There's other ways of plugging into major trading hubs to then trade your stablecoins using this bot and then making a yield. So Seb quoted me 3 to 5% monthly returns his bot creates. One of the problems, though, is it's not consistent. It's lumpy. You have to be patient. It is, in a sense, a set and forget trading strategy, which I really like. It's not going to take up lots of my time once I've figured it out. But you don't want to be a forced seller. You don't want to have to exit positions until the bot says it's time to do so. And with that in mind, it's like, okay, so really what you want to do is you take a Bitcoin leverage position with an amount of Bitcoin of your net assets that you're happy to be able to top up should there be liquidity risk of a margin call. And as the loan expires, you could just take out a new loan with additional Bitcoin and pay back the stable coin that you took out originally with the new loan. And this for me was like, oh, this actually makes sense. Because when I'd previously been thinking of, okay, I should take some loans against my Bitcoin, I hadn't really understood, like, well, how will that work when the loan expires? Okay, you've got to take out another loan. Yes, you're still constantly in debt, but if I'm going to use it for just paying my expenses, I'm hoping or betting that the price is able to beat my expense rate. And that just didn't quite feel right. It felt a bit too risky for me. But here it's like, actually, I can now deploy the loan in a way that actually creates additional capital through the trading strategy, which in some ways is like a yield. So let's say you take out a 50% loan to value ratio. So you put one Bitcoin in, it's 100K. You get a $50,000 loan. Okay, that's going to cost you 12% per year. So that's 1% a month cost of capital. Okay, well, if I can generate 3 to 5% a month from an algorithmic trading bot, now you're looking at a net margin each month of 2 to 4%. Interesting. Now this starts to then look much more like a traditional investment. So it's like, okay, I've got a piece of real estate. That real estate is leveraged, but I'm running a pub in it. And I'm able to pay back the cost of the leverage with the operation that I'm running on top of it. So in this case, it's like, actually, I can pay for the cost of capital with my trading strategy, which I'm going to assume is a highly sophisticated AI-driven model because they're getting good results. And they can make money on the downside as well as the upside. So in an environment where, okay, we might hit an all-time high over the next 3 to 6 months of, I don't know, somewhere between 150, 250K. Dr. Jeff thinks we're going to hit 400, 500. Is that actually the case now? I don't know exactly. And that's okay. But what I love being is long Bitcoin. Capital growth for days. Yes, there's volatility, but I don't want to sell it. What doesn't make sense to me is sell Bitcoin and use the stablecoin position that you get out of that, or whatever, the cash position, to then just trade. So it's like you make a 3 to 5% yield, but there's no capital growth potential underneath. Whereas this way, it's almost like a tiered system of like, I've still got my Bitcoin position, which for me, that is the beating heart of this wealth strategy. It is the engine room. It's how things actually continue to grow in purchasing power. Yes, the short-term volatility I've mentioned, but that is the position I do not want to sell. And this setup that I'm now talking about, it's like, okay, non-custodial, I therefore remove the tax risk. There still is liquidity risk. So I need to make sure I have a position of a size that I'm comfortable to add Bitcoin into should I need to do that. But you're able to start creating a margin each month with the cost of capital. Ooh, now this gets spicy. Anyway, I'm going to leave it there. If you have any questions about what I've run through today, as I mentioned at the very start, reach out, hi@jakewoodhouse.io. I'm going to stop sharing the screen quickly here. And yeah, I'd love to hear from you, because at the end of the day, these are all ideas. I haven't actually done this yet. If I do put this into action, I will, of course, do a video about it, because there's nothing more important than the actual experience of going through it. Did it work? Did it not work? What was hard? What wasn't hard? What would I not do again? And this is where it's quite good fun. Essentially, I'm building a position where I can start to speculate a bit more at the fringes. So, with as I already called it, Bitcoin, the engine room, pumping away in the center of your wealth strategy, you can start to think slightly further on the risk curve. Well, okay, maybe we should do some trading, or maybe we should take some debt. How do we actually leverage ourselves or position ourselves for a time where things are going to be super inflationary? That doesn't mean that your actual purchasing power is going up. But we need hard assets. We need Bitcoin. We need gold. Maybe there are other equities to look at. I've obviously recently done a deep dive on Setlantis and doing some early stage equity investing. I'm about to have an episode with Alan Farrington coming out from Axiom Capital. Fascinating guy, talking about how right now is essentially temporal arbitrage. In the future, every business is going to be a Bitcoin business. But right now, when you've got startup building on Bitcoin, having Bitcoin on the balance sheet, highly motivated founders building stuff that actually is needed, that's an extraordinary early stage equity opportunity that not enough people are even looking at. Anyway, I'll leave that with you to follow up and watch the episode with Alan when that comes out. Hope that's exciting and interesting for you. Thanks so much for your time.